There is a quiet assumption many people carry during times of crisis. When the world feels unstable, the instinct is to believe the market must follow that same instability. Prices fall, headlines worsen, and it begins to feel like everything is moving in one direction, down. But markets do not work that way. In fact, some of the most important signals about the future appear when things look the most uncertain. And often, the biggest mistake is not what people do during calm periods. It is how they think during chaos. Because while headlines focus on what is happening now, markets are constantly trying to understand what comes next. That gap between perception and reality is where most investors lose clarity. Most people believe that market declines during global conflict are driven purely by fear, that when uncertainty rises, investors simply react emotionally, pulling money out and waiting for things to stabilize. It sounds reasonable, but it is incomplete. What is often missed is that markets are not reacting to today's events. They are reacting to expectations about the future. Energy disruptions, supply chain shocks, shifts in consumer behavior. These are not just immediate problems. They are signals about how the economic system might behave months from now. And when those signals change even slightly, markets begin to adjust before the headlines do. This is why you sometimes see something that feels counterintuitive. Negative news continues, yet certain parts of the market stop falling. Some even begin to stabilize, not because conditions have improved, but because expectations have already shifted. That is where the real story begins. A more useful way to look at volatility is not as chaos, but as a sorting mechanism. It separates businesses that are fragile from those that can absorb pressure. It reveals which companies depend heavily on perfect conditions and which ones are built to operate through disruption. One of the most consistent investors in history tends to avoid complexity and instead focuses on durability, not predicting short-term movements, but understanding which businesses can continue functioning under a wide range of outcomes. This way of thinking leads to a different question, not what will the market do next week, but which businesses are still functioning when conditions are difficult. Because when conditions normalize, and they always do, eventually those are often the businesses that recover first. This brings us to a simple but powerful principle. Strong businesses in weak environments often tell you more than strong businesses in strong environments. When everything is going well, almost every company can appear successful. Revenue grows, margins expand, and optimism is easy to maintain. But when conditions tighten, the differences become clear. Some companies begin to struggle immediately. Others slow down but remain stable. And a small group continues operating with relatively minor disruption. That last group is where attention tends to shift, not because they are immune to downturns, but because they demonstrate something more important: resilience. Now, this does not mean these businesses will always outperform. Markets are complex, and outcomes are never guaranteed. But resilience under pressure often becomes a leading indicator of how a company might behave when the pressure is removed. A useful way to think about this is through relative strength. Not absolute performance, but performance compared to peers facing the same conditions. If an entire sector is under pressure, yet one company declines less than others, that difference matters. It suggests something about its structure. its positioning, or its exposure to risk. And when the broader environment improves, those differences do not disappear. They often become more visible. To make this more concrete, consider the financial sector. During periods of uncertainty, especially when energy prices rise and economic growth slows, financial institutions tend to face pressure. Lending activity declines, investment banking slows, and risk increases across the system. It is not difficult to understand why the sector struggles. But within that same environment, not all institutions behave the same way. Take Citigroup as an example. While the broader financial sector may face significant declines, a globally diversified institution can respond differently. A large portion of its business is not tied to a single economy, but to the movement of capital across many regions. Its treasury and cash management operations support transactions in dozens of countries. This creates a type of revenue that is less dependent on any single market condition and more tied to the ongoing flow of global commerce. When supply chains are disrupted, that flow slows, but it does not stop. And when those systems begin to recover, even gradually, activity tends to return quickly. This is not about predicting a rapid rebound. It is about recognizing that certain business models are positioned closer to the underlying mechanics of the global economy, and those mechanics tend to recover before sentiment does. A similar pattern can be seen in other sectors, though for different reasons. In communication services, for example, demand is relatively stable. People continue to rely on connectivity regardless of economic conditions. But spending behavior can shift. Consumers may reduce discretionary expenses. They may delay upgrades or move toward lower-cost options. This creates pressure on companies that operate at the premium end of the market. Yet even within that pressure, differences emerge. Verizon operates in a segment where pricing power and infrastructure scale play a significant role. Its revenue is tied not just to usage, but to the type of service consumers choose. During uncertain periods, growth may slow, but the underlying demand remains. And when confidence returns, even slightly, spending patterns can adjust quickly. This creates a situation where the downside is somewhat limited by necessity, while the upside is tied to shifts in consumer confidence. Again, not certainty, but asymmetry. In transportation, the dynamics are even more visible. Airlines are highly sensitive to both fuel costs and consumer demand. When energy prices rise and uncertainty increases, the sector often faces immediate pressure. Flights become more expensive to operate. Travelers become more cautious. Margins tighten. Yet even here, structural differences matter. Delta Airlines has a unique position within its industry due to its partial control over fuel processing through its refinery operations. This does not eliminate exposure to rising oil prices, but it changes the economics. Instead of being purely a buyer of fuel at market prices, it participates in the value chain. This creates flexibility that other airlines do not have. At the same time, demand for travel, particularly in certain segments, has shown a tendency to recover faster than expected once conditions stabilize. These are not guarantees of performance. They are examples of how structure influences outcomes, and that brings us to a broader idea. Markets are not simply reacting to events. They are constantly re-evaluating probabilities. When uncertainty is high, probabilities are wide. Outcomes could vary significantly. As more information becomes available, those probabilities begin to narrow. And when they do, prices adjust, often before the narrative changes. Understanding this process does not remove risk, but it changes how risk is interpreted. Instead of viewing volatility as purely negative, it becomes a source of information, a way to observe which systems are under strain and which continue to function. That perspective does not lead to quick decisions. It leads to better questions. And over time, better questions tend to lead to better thinking. If there is one pattern that repeats across nearly every market cycle, it is this. People tend to focus on outcomes, while experienced investors focus on process. When prices fall, the natural reaction is to search for certainty, to ask when things will recover, how long the downturn will last, or which areas will rebound the fastest. But those questions assume something that rarely exists in markets' precision. A more grounded approach begins with acknowledging that timing is uncertain, but structure is observable. In other words, it is difficult to know when conditions will improve, but it is possible to evaluate which systems are more likely to function when they do. This is where a second principle becomes useful. Short-term uncertainty matters most for those who depend on short-term outcomes. Long-term outcomes depend more on whether the underlying system continues to operate. This distinction is often overlooked. For someone who needs capital in the near future, volatility is not just uncomfortable. It is a real constraint. The timing of market movements becomes critical because there is limited flexibility to wait for recovery. But for capital that is not tied to immediate needs, the situation is different. The question shifts from what happens next to what is still working. That shift may seem subtle, but it changes how decisions are framed. Instead of reacting to price movements, the focus moves toward understanding business durability, cash flow stability, and the ability to adapt under pressure. This is why long-term frameworks tend to emphasize consistency over prediction. Because while predictions can be wrong, systems that are built to endure often continue to do so regardless of the environment. Now, this does not mean all decline should be ignored or that every downturn leads to recovery on the same timeline. History shows that markets do recover over time, but the path is rarely smooth and the duration can vary. Periods of recovery can take months, sometimes longer. And during that time, sentiment can shift multiple times before stability returns. This is where another common misunderstanding appears. Many people assume that once a major event ends, markets will immediately return to normal. In reality, markets respond not just to the end of uncertainty, but to what remains after it. If a disruption affects energy supply, for example, the resolution of the event does not instantly restore supply chains. There is a lag. Infrastructure must be rebuilt, logistics must normalize, and confidence must return gradually. So even when the catalyst for uncertainty is removed, its effects can persist. This creates a second layer of analysis. Not just what happens when the event ends, but what conditions remain after it ends. Because those conditions shape the pace and strength of any recovery. Take the financial sector again. If economic activity slows during a period of disruption, lending declines. Investment activity slows. risk increases. Even after conditions stabilize, it takes time for businesses and consumers to regain confidence. If financial institutions begin to recover quickly, it can signal that the underlying economy is stabilizing. If they do not, it may suggest that deeper issues remain. In this sense, markets become a feedback mechanism. They do not just react to reality, they help interpret it. The same logic applies to consumer-facing sectors. In communication services, stability in demand does not guarantee growth. Consumers may continue using essential services, but their willingness to spend more depends on confidence. If confidence returns slowly, recovery in higher margin products may also be gradual. This is why some companies appear stable but do not immediately accelerate. And in industries like transportation, recovery depends on both cost structures and demand patterns. Fuel prices, operational efficiency, and travel demand all interact. Even if one variable improves, others may lag. So rather than expecting a single turning point, it is often more realistic to expect a sequence of adjustments. Gradual, uneven, and sometimes difficult to interpret in real time. This leads to an important limitation. Even when a business appears resilient, external factors can still shape outcomes. A company may be well positioned within its industry, but broader economic conditions can override those advantages. Prolonged weakness in demand, unexpected policy changes or shifts in global trade can all influence results. There is also the risk of misreading signals. Relative strength during a downturn does not always translate into leadership during recovery. Sometimes it reflects temporary factors that do not persist, and market expectations can change quickly. A business that appears undervalued based on current conditions may remain under pressure if those conditions do not improve as expected. This is why a balanced perspective matters. Not every resilient company becomes a long-term outperformer. Not every downturn creates opportunity, and not every recovery follows a predictable pattern. Acknowledging these limitations does not weaken the analysis, it strengthens it, because it introduces realism into the process. It replaces certainty with probability and prediction with observation. And over time, that tends to produce more consistent thinking. So what remains after all of this? A simple mental model. Markets are forward-looking systems that constantly adjust expectations based on incomplete information. During periods of uncertainty, those expectations become unstable. Prices move quickly, often overshooting in both directions. But within that movement, patterns begin to form. Some businesses weaken significantly, others hold steady. A few demonstrate resilience that is not immediately obvious, but becomes clearer over time. Watching those patterns is often more useful than reacting to headlines, because headlines describe what has already happened. Markets attempt to price what might happen next, and the gap between those two perspectives is where most confusion and most opportunity for better thinking exists. So rather than asking which direction the market will move next, a more useful question might be this: what is still working, even when conditions are difficult? Because the answer to that question tends to matter long after the headlines have changed. And if there is one habit that separates reactive decisions from thoughtful ones, it is the willingness to pause and examine that question carefully, not to act quickly, but to understand more clearly. If this kind of thinking is useful, continue exploring how different environments reveal different types of businesses. Over time, patterns begin to repeat, and recognizing those patterns is often more valuable than predicting the next headline.